right, opening bell on Wall Street right now. Normally we should be able to hear that little ding, 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 ding. It is 9:30. There we go. And it looks as if the Dow is already down 527 points. That is to be expected. The futures overnight were down, as well as markets overseas, including in Asia and in Europe. So I think a lot of people were expecting that we were going to see a downturn. Now, there are many hours to go in the trading day, so obviously we're going to keep an eye on what goes on here. But clearly, market is still heading lower, and that is certainly going to be cause for concern for some people. Although, as we've been pointing out, as Melody Hobson pointed out, historically, a 4% drop, like the one we saw yesterday, down about 2%. Given that we've seen a 30% increase in the market over the course of the year, just sort of gives people a little bit of perspective on this. And again, when we talk about the single largest point drop in stock market history, which yesterday was, the 1987 crash was a 22% drop. So percentage matters way more in this scenario than the actual point drops.
It's not that bad, is what you're trying to tell me.
Well, I think that, it certainly, there's wealth that is being lost, for sure. I don't want to downplay what we're seeing here. Wealth is being lost, but the reality is that in the grand scheme of things, when the market has been as good as it has been for the last couple of years, something like this is to be expected. So let's bring in.
We are going to talk more about that because Nick Martell is here. He's the co-founder of MarketSnacks, a daily newsletter that breaks down what's happening on Wall Street. And he's with us now as the market's open for the day. So when you just arrived, we were talking a little bit about what the futures were and how you would check your phone on the train over here. And the futures were way down, and then they seem to have sort of halved the expectations.
Yeah, a lot of that has to do with the world. And when you look at global markets, what happened in Japan, what happened in Europe, they react to what's happening here in the United States. New York's kind of the center of the world in so many ways. So the buck stops with New York and with Wall Street. If things can calm down today, we could see that happen in the rest of the world. But after yesterday's sell-off, it was kind of inevitable that would happen internationally too.
So one of the things, as we look at the market, it's sort of gyrating here. It's actually not, as you recall yesterday, we were watching it, and at one point it dropped significantly within the course of just 20 minutes, and I could sort of feel that there was a little bit of panic there. This seems to be just sort of what I would call a normal market gyration. In fact, the market seems to be clawing its way back here. But what people sometimes don't understand, and this is something that we've talked about in the past, which is because the president generally likes to equate the stock market with the economy, he likes to talk about the stock market in the same breath that he is talking about the economy. Counterintuitively, the fact that the economy is doing so well, the American people should take heart in the fact that our economy is doing well, is part of the reason we've seen this sort of sell-off in the market.
Right. The two are related, but not the same thing. And that's important to keep in mind here. I mean, the economy has been doing well for a number of years. The stock market has been doing exceptionally well. But there's this funny counterintuitive issue that happens when the economy is heating up. The Federal Reserve likes to kind of knock things back a little bit, maybe raise interest rates to rein in stocks. So while the economy can keep moving forward, you can kind of see a pullback in stocks that are reacting to that, maybe expecting the economy to slow as a result. Because interest rates are really the key here.
So that's one component that we've been talking about. But any other factors that may have been at play when we saw that deep dive?
Oh my God, there's so many factors. And that's what kind of makes yesterday a fascinating kind of case study. Because you can point to a number of things. So first of all, we have a new Fed chairman in charge now. Janet Yellen just left last week. We now have Jerome Powell. So first day on the job, kind of a brutal first day.
Because especially because the market started dropping on Friday when Janet Yellen was cleaning out her office,
and I don't want to suggest that that the fact that they did not allow the press to actually cover his swearing in may have had an effect on that. Well, it's sort of like people are, what are you not allowing us to see? They slickly produced an opening or sort of a welcome video that he did. But again, I'm just suggesting that it's better to have transparency, more transparency than less.
And the Fed gives limited amounts of transparency. So we know, for example, that the Fed was planning on starting to raise rates again. And as full context, since basically the '08 financial crisis, rates have been like super, super low. They've even been negative at some points in Europe. So that's been kind of fueling an interest in going to stocks. Because when rates are low, you're going to get less of a yield out of bonds. You're going to be pushing into the stock market. That's what's fueled the stock market. Now, with rates rising, you have a situation where maybe investors are saying, you know what, I could get a return on bonds in a way that might match in some way stocks. So you have people pulling out of stocks and starting to put things into bonds.
There is one thing that has concerned me, and that is the fact that the United States still lags other countries when it comes to the savings rate. Is that something that concerns you as well?
Yeah, I think that the savings rate doesn't have the same impact as maybe what people are doing and how they're involved in the stock market. I think a key here about the stock market and thinking about rates is also how it affects companies and profits, because regardless of the savings, if you have companies who are now actually hiring more and are actually increasing wage gains, like in the jobs report, we saw that 2.9% wage gain.
Which was we hadn't seen in quite some time.
Biggest in a decade. So that means, that also can apply great for the American worker, could potentially be putting more back into savings, but that also could be hurting, corporate profits. And right now we're in the middle of earnings season. So that's actually just another one of those effects that actually could be hurting stocks and what contributed to yesterday's big drop.
And you were also talking about sort of the computer trading, that because now, they can trade very, very rapidly, fractions of a second, and you can see rapid movements because of that.
Oh, it's like totally freaky. We were joking around that, when they show Wall Street traders freaking out about yesterday's drop, they just show a bunch of computers. Because in the end, what happens is, and you see this, because you didn't see this, 15, 20 years ago, you didn't see it with the stock market crash that Martin Zweig called in 1989, that, or in 87, what you see now is suddenly in 6 minutes, the Dow will drop 700 points. And what happens is these computers see it happening. They're all set to react to it. But then they also know that once the stocks drop a certain amount, they end up buying back. So you then have these rushes back up with the markets. And if you're just a retail investor, a regular person investing in the markets, sure, maybe it made up for that big loss within a few minutes. But the reality is you're seeing that volatility, and it's playing into what you may do and may sell.
I call them gyrations.
Gyrations.
I will remember that.
Gyrations. When my very first job on the street was as a runner on the floor of the New York Stock Exchange, when I don't even know if they still have that job, when you were essentially running around through the different
robots.
Trading. Now it's like you pointed out, there's mostly computers, and my job has been completely automated. But again, it just goes back to the concerns that some people have about this, whether or not it's historic. You're looking at the market right now, it is down less than 1%. And who knows where we'll be at the end of the trading day. But again, this is not, the sell-off that we saw yesterday wasn't even in the top 20 in terms of percentage-wise.
No, you've seen 100 of them that have been worse. And what I think is important to think about is making the distinction between a panic and the distinction between that and just a correction. The other thing that's on the table here is that investors have seen the stock market ripping for the last few years. The Dow is up 3 times what its average would be over the last 12-month period. That's huge. So part of this is also just kind of selling to take back those gains and kind of pull some stuff off the top. Similar to what we saw in the cryptocurrency markets over the last couple weeks, where there were concerns and people start pulling back because they realized they made a lot of money on this and they may want to cash in.
So I always like to ask just the regular person question, because I do not have stocks and bonds. I have a 401k. Sometimes I look at it. Sometimes I choose to close my eyes. This might be one of those times where I do not log on. But should I be worried?
Well, all right, so I think this is the best way to ask that question. Do you remember what you were doing on August 24th, 2015?
Absolutely not.
Right, you don't. So that was the last time the market dropped this much. You had this huge kind of freak out because there were concerns about China's growth. You had things coming up with oil prices. Markets plummeted. People were freaking out. They were going on TV like this. They were saying, just be careful. Don't worry. What's happening here? But then we kind of recovered, and the market's up huge since then. So you got to kind of think of it in that context of a more longer-term horizon. Sure, there are going to be days like this happens, and this could erupt into something bigger over time. But the reality is, most of the time, when this kind of thing happens, it's just a blip.
All right.
Wait it out. I do think also, and it's just what we were saying earlier, right? The president, I think perhaps he will realize that it's not a good thing to consistently tout the stock market returns, because when you have a day like we saw yesterday or on Friday, you have to own, if you're owning the fact that the stock market goes up, which has absolutely nothing to do with who's sitting in the Oval Office, then you have to also own when the stock market goes down. He was very silent yesterday. Not saying he should have commented.
I was going to say, you don't have to, he doesn't have to own it. He's not going to own it.
Well, he doesn't have to, but clearly it's perhaps a sort of a shot across the bow that the economy is doing well. Over the course of the last year that President Trump has been in office, the economy has gotten better. It had been on an upward trajectory, but it is getting better for sure. The stock market is its own thing. Let it do what it's going to do. The market has a mind of its own, as you know, and trying to be, for those people who don't own stocks, who are concerned about their 401ks, when they hear economy is doing great, check out the stock market, people think that that is linked to the economy, to their wages, to the growth of companies, and it doesn't always mean that.
Right. It's so much more nuanced than that. And historically, that's why presidents tend to not associate the economy with the stock market, because you got to take the losses along with the gains, and they know that they're separate. They can't control everything. And the other thing to keep in mind here is that what's kind of cool about finance and what we love at MarketSnacks is that every part of the economy and finance in general is somehow combined. It's this wonderful ecosystem. So when you have stocks dropping like this, you then have investors kind of maybe pushing to buy the US dollar. That can push the US dollar price up. Oil prices are in US dollars, and when the price becomes too expensive as a result of that, oil prices drop, or oil prices can drop. So you have this kind of funny connection where everything that was happening yesterday ripples throughout everything in the markets. And all that interconnectivity is pretty exciting to see. But it also shows you why it's kind of a dangerous thing, and you don't want to tie everything about the economy to just what's happening in the stock market.
Well, we'll say that Sarah Huckabee Sanders was asked about that, about the president taking credit for the stock market, and she said precisely what you said, which is that the president is focused on the overall economy and all the great things happening in terms of that.
Look, I get it. It's easy to point to something. It's a barometer and a benchmark that you can point and say, look, this is, if you want to give me a report card, grade me on the market. But the market doesn't always go up, and that's just what we saw yesterday. I mean, it sounds sort of like self-evident, but that's really what we're talking about here. And the idea that you're constantly going to tout it means that when you see something like what you saw yesterday, you got to sort of own that too.
Nick Martell, MarketSnacks, always good having you here.
Love being here. Thanks, guys.
Thanks, Nick. Appreciate it.